You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. Welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo, coming to you from the Options Insider Radio HQ here in the options capital of the world, Chicago, Illinois. And of course, we produce quite a few fun programs here over there at the Options Insider Radio Network, including hundreds of archived episodes here of good old Volatility Views. And we encourage you, if you haven't done so in a while, go back, check out some of those archive episodes, particularly if you're a new listener. A lot of great debates and discussions about all sorts of different aspects of the volatility market. Not just what's trading today, we do get into that as well, of course, but also all like our episode last week where we got deep into the primal origins of skew and all sorts of fun stuff. A lot of that is buried deep there in those archives. So check them out if you haven't had a chance. A lot of great guests have been on the show as well. We're going to try to help surface that for you a little bit going forward, perhaps as some sort of best of feed. We're working on putting that together now, but definitely good stuff for you guys to check out. Indeed, that's pretty much the case for all of our 13 programs on the network. You can find all of that great stuff pretty much on our website, theoptionsinsider.com, Insider Radio Network tab, top left corner of the homepage, and you're pretty much good to go from there. The overlay pops up. You can pick your show, download, stream, whatever you prefer, and you're off to the races. Of course, you can also just mainline all that radio, iTunes, TuneIn, Stitcher, et cetera, et cetera. A little bit harder to get some of the back catalog on those services because they kind of cap it how many you can see per page, et cetera. So if you want to get the full deep dive, the website's still the best place to go. Or, of course, you can grab our mobile app and pretty much dive into it there, too. It's pretty easy to get the old stuff on the mobile app as well. So no shortage of ways for you guys to download as much content as you could possibly handle. If you woke up this morning and said, hey, I really need myself some options content, well, we've got you covered. So no shortage of ways for you guys to download and enjoy all that fun stuff. And, of course, while you're listening, send us your questions, your comments, your insights. We'd love to hear from you guys. And joining me on the program today, my volatility compatriot, some may say nemesis, the greasy meatball himself, Mr. Mark Sebastian from optionpit.com, as well as this new venture. Is it Carmen Line Capital? Am I getting that correct?
Carmen Line Capital, volatility arbitrage hedge fund. Because
you're a huge fan of Carmen Miranda and her dancing in the line.
No. The scientist named Carmen, and he was a Hungarian, and they named the separation of the Earth's atmosphere to outer space the Carmen Line after him, and mostly because we expect our returns to be outer-worldly. And I've assembled a pretty crack team for our fund. I think I've got probably certainly the most interesting man in Chicago in myself. I've got the smartest man in Chicago in Sam. I've got the most business savvy man in Chicago in Adam, and then I've got a Mainer named Andrew.
Got to have someone in the hinterlands out there to watch over all you crazy Chicago folks.
Exactly. He's got his one working eye all over us.
Don't believe his spiel, listeners. It really was about Carmen Miranda. All right, as we keep on rolling into our first segment, the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review, the portion of the program where we break down the week that was. From a volatility perspective, we are recording this middle of the session here on Friday, October 23rd, for all of you playing the home game. And we were in a prolonged downside stretch here on the old volatility front with measures like the VIX Cash languishing to the south of the 15 handle. In fact, they even got, they believe this morning, touched into the 13 handle, about 13 and a quarter or so today. So from that perspective, certainly VIX Cash getting quite low. But as the session has progressed today, and indeed this week, we've seen a little bit of vol coming back in with some upside love today out here on the street. Most of the major indices up nearly a full percentage point or so, and the NASDAQ up well beyond that. And all that upside love means, of course, upside love in the volatility space as well. We'll get to that in a little bit. I know these types of days always have a lot, particularly on the retail side of the fence, kind of scratching their head saying, wait a minute, I thought it's supposed to be an inverse relationship. And it is indeed, except for times like this when a lot of other funky things are going on out there in the land of VIX futures and a lot of other products. But before we get into all that stuff, let's start at the top. Mr. Greasy Meatball, Mr. Carmen Miranda Fan Club Chief, what was cooking, what was catching your eye this week from a volatility perspective?
Well, you know, they kind of imploded volatility, then bid it back up. And now it's been kind of stuck around 15. So what I'm noticing is that, I think that that lows for the time being are going to be 14, 15, not 11. And so I think the volatility environment has changed. And we're now in a strategic up move, if you will, of volatility.
It does have a bit of that flavor to it, doesn't it? Of like, oh, we sold it. Oh, wait, we oversold it a bit. Let's put a little bit of that back in. It kind of, to me, has a smacking of kind of like what we used to see, particularly in the early days of the weekly options, where people would crush them, particularly going into the weekends. Then probably maybe we sold them a little bit too much. We're selling them out to like Tuesday and Wednesday's prices now. Let's get some of that back. It kind of has a little bit of that flavor today, doesn't it?
It does, indeed.
Yeah, these are these days where, of course, people always scratch their heads saying, why is this happening out here in volatility land? It is so confusing. Like I said, we're hovering south of the 15 handle right now. VIX Cash about 1470 or so. Again, like I said, after rallying from the lows of the 13 realm earlier this morning. It's been quite a pronounced downside. We were talking not that long ago on the show, listeners. How long is this streak above 20 going to last for the VIX Cash? It lasted about 30 sessions, and now we've been below 20 for about 12. So we'll see how long that side of the fence leans up. Of course, the streaks, quote unquote, below 20 should be longer if indeed you do know your VIX history. 20 above 20 is a bit of an aberration. Below 20 is more of the where VIX likes to hang out for extended periods of time. Of course, that streak above 20 was the longest since January of 2012. And Mark, we've seen some interesting stuff going on out here in the VIX futures land as well, kind of perhaps showing again. You and I have remarked, and I think Andrew and I have remarked recently, that it seemed like they had kind of just squeezed kind of all of that juice out of across the term structure out there in the futures, kind of coming out and saying, yeah, China's done, the Fed's done, let's just squeeze all whatever premium was left from them out of these. And now today it seems like kind of like we're seeing with the VIX Cash again, while that measure is rallying, they're kind of saying, whoops, maybe we overdid it a little bit. Let's put a little bit of that juice back in. Is that your take pretty much from what's been cooking out there in the VIX futures as well?
Yes. VIX futures have been pretty firm. You got a nice spread between the November and the cash. They're definitely staying above kind of that 16 level. When VIX gets kind of overly depressed, they are not following suit quite as much. VIX of VIX continues to be super super firm. And I think that's kind of interesting. Even though, VIX is sold out back to 14, the VVIX is still around 100. So what that tells you is that there's still real demand. And actually, one thing that's interesting is that, we saw VVIX start to drop below 90 as VIX was coming off from about 19 down to about 16. Once VIX broke into the 15s and 14s, we started to see some serious option buyers again. So, I thought that was kind of interesting.
Yeah, I'm looking here at a chart right now of good old VVIX, and that aberration back in August aside, it had that ridiculous spike north of the 200 handle, but then it kind of got its senses back again, and it was kind of vacillating north of the 140 range for a while. Then it's been on this kind of long, slow progression to the downside ever since. But you're right, around this 90 odd level seems to be where it's kind of caught its footing, and it's kind of bounced off that a few times as people, you're right, keep coming back in and saying we're going to pick up a little bit of this stuff here because it suits our purposes. We'll get to some of the VIX options flow we've been seeing in a little bit. You mentioned the VVIX, Mark, kind of the other metric out there a lot of people have been looking at and pointing to. We talked about it last week, and it has changed starkly again this week, is, of course, the much bandied about, often misused CBOE Skew Index. Last week we were talking about it pretty much was flirting with record high levels, and that wasn't particular. It was surprising to the degree that it had marched up there, but the movement to the upside there in the Skew Index doesn't surprise anyone who's familiar with how that product works. Of course, kind of measures a lot of the hedging interest out there in a big product like the SPX, and shows how much people are paying for the puts versus the calls from an implied volatility perspective. It got to a high last week, I believe, of 151. So pretty strong levels if you've been following that product at all. And this week, despite the fact that we're seeing still a pronounced rally in the markets, that hasn't really given up the ghost at all this week. It seems like, at least if just a pure reading of the Skew Index, that has come off commensurately, off about 30 handles, got down to about 121 now versus the 151 level. The previous high it had hit before that was about 140. So it's been kind of on the rampage of late. You and I have talked a lot about some of the pros and indeed some of the minuses of relying too heavily on the surface value of the Skew Index. But still, this is a pretty stark move. Even you don't see this product or index moving around this much, and it's been rocking and rolling of late. So what's your take on kind of this really huge drop we've seen in the Skew Index this week?
Well, I mean, one thing to recognize is that a Skew Index of 150 is disgustingly high, and 120 is still elevated, but more normal. And so I just think that as the market has rallied a little bit, and as volatility has come in, typically what you'll see is vol come in, then skew come in, and that's the path that we've seen. Generally speaking, when volatility first comes in, skew steepens. Then once volatility kind of sets itself in a level, skew will then start to flatten up, and that's exactly what we saw. It's one of the least shocking things I've seen in a while.
Certainly not as shocking as the Carmen Miranda hedge fund you were running there, sir.
It's the Carmen Dance hedge fund. Thank you.
The Carmen Opera will make it a little bit classier than good old Carmen Miranda. A dated reference if ever there was one. Of course, here looking at the numbers out of the SPX kind of backs that up as well. We're rocking in pretty historic low levels from a skew perspective. The 30-day skew out there at about a 34%, which is from the past year, the bottom, essentially one percentile there. So about as low as it's gotten, certainly over the past year. So that kind of backs up what you were saying there, Mark, that we certainly seem to have found this kind of level here from a vol perspective, and people have gotten their hedges on, and certainly there's a lot more panic to do so last week. Not so much this week as these levels and these numbers kind of coming in some epic fashion. Of course, we are looking here. This is the third week, I believe, here now of the great experiment into short duration VIX contracts, aka the VIX Weekly Options, and so far at least seems like another robust week from a volume perspective. Looks like I checked it right before the show. It seemed like they had already put up about 5,000 or so contracts in those two weekly strips. A lot of people writing in too, by the way, just kind of an aside before we even get to the mail block. A lot of people asking, hey, why are there only two VIX weekly options. That seems to be the way they're rolling them out so far. So it's not a mistake. It's not an error on the part of your brokers. Like a lot of people thinking, hey, I'm only getting 2 of these. That's just the way they're rolling them out for now. Maybe they'll add that full strip. People are used to that full kind of monthly strip of weeklies. They've seen CME and others do that, and other products do that. But for whatever reason, we only got the 2 right now in VIX options. So no, it's not an error on the part of your broker. It's just the way the products are rolling out right now. But in terms of what we're seeing here, about 5,000 contracts today. We saw weekly puts and calls lighten it up today. About 1,200 of the weekly expiring October 28, 16 puts going up, as well as 1,000 of the Oct 23 calls expiring on the 20th as well. Those are going up for a nickel, so probably closing there. A little bit of a short-term dalliance with the dark side. But it seems like, Mark, about 3 weeks in or so, the VIX weeklies seem to be an unqualified hit. Would you concur, sir?
Yeah, I mean, I think that one thing we know is these weeklies have been specifically additive, and we've seen the futures jump as well. You can see that front month. What we really needed to see the volume pop, because they started out a little slow, but now that weekly option is the front week option, and is kind of right in front of everything, now we're seeing one where there's real volume. I'm looking today, and it looks like there's at least 10,000 contracts that have traded in the name. Now, there's still way more contracts in the big November contract, but it's exciting to see this thing roll out and work.
Yeah, you're right. Looks like quite a few more have gone up even since we started the show here. I'm seeing deep OC 14 halves the expire on the 28th going up about 4,000 times for a $1.05. Yeah, you said that right, listeners. The 14 halves. So actually not that deep, but still interesting stuff here. Yeah, 4,000 alone in that strike. So that's almost double what we had seen the entire day already. So yeah, a lot of volume, almost close to 10,000 contracts today in just the weeklies alone. About 6,000-7,000 just in this 1 month here, the Oct 28 months or series. So yeah, interesting stuff. Clearly, people are not hesitating at all. They're diving into these products with relative gusto. 4,000 Oct 14 halves. Interesting stuff. Looking at the mothership VIX options, we kind of saw some love out here as well. Again, kind of speaking to the narrative we're seeing now of why the vol is firming up a little bit out there. We saw a lot of buying opportunities out there for a lot of people out there. On the put side as well, Nova 16 puts lighting it up earlier this week, about 15,000 of those going up. Paper buying them for about $1.55. No 30 calls, a little bit on the upside there, going up about 13,000 times. Also paper buying for about 34 cents. We saw a couple of, looks like risk reversals going up in Nove and Dees yesterday and today, about 10,000 times each. Dees 2025. Financed by the 14 puts as well as the 1820 coup call spread versus the 14 puts. Each of those going up about 10,000 times. More upside buying, 1926 call spread, and Nove also going up. Again, some of the actual activity here is obscured by just an enormous amount of open interest on a lot of these strikes out here in VIX land. It's kind of hard to intuit. Are they opening? Are they closing? When there's tens of thousands of other things going up on these strikes. Big print earlier this week, the Nove 30 calls going up for 35 cents, close to 50,000 times back on Wednesday. Again, that's a huge strike as well as a lot open there, over 300,000 contracts open on that strike, but that's been the strike du jour a lot this week. Looks like another 17,000 or so going up today. So it seems like we're back to our earlier narrative of people essentially coming in and wanting themselves some upside here in good old VIX options land. We saw that kind of fade a little bit, and particularly as people were taking their money off the table after the big spike in August, and now we're seeing people again starting to prep for some upside here. Mr. Carmen Miranda, what? It's not going to get old for me anytime soon. What caught your eye, if anything, out there in VIX options land this week? Anything lighting it up over there in the pit chat as well from a VIX options perspective?
There was a lot of risk. Once we got down to this 14, 15 level, we started seeing some big risk reversal going up. Some, a lot of the standard short put versus long call spread, I think I saw go up over and over and over again in November. Most people targeting somewhere, 18, 19, 20 versus the 25 strike. And then shorting the 15 put. So that's really been the what I think have seen as the big trades in November.
Yeah, you saw it in D's today too, like this, or just this week as well. It's just kind of that, you're right, that range 14, 15 put versus some sort of 18 to 20 call, and then the upside 22 or 25 call. That kind of range of that bullish risk reversal seems to be, you're right, the kind of the trade du jour this week, going up in blocks of 10,000s, all different strikes and times. But that seems to be the hot call this week. Again, people using wherever they can to get themselves some upside exposure. Up here in the VIX options, looking at what the net big strikes are on the board this week, the top 10 hot VIX strikes. Looks like calls once again leading the charge. You got to go pretty far down to find any puts. Kicking things off, the no 30s, no surprise, I mentioned before, that's an active strike with a lot of open interest, nearly 350,000 contracts open there to be precise. So that is indeed our number one hot VIX option strike, and then 300,000 of the no 20s as well. I believe that coincides with our 1x2 friend there. I'll have to check to confirm, but I believe those are some of the strikes he's open on. Jan 30s going up as well, about 250,000 open there. And then number 4, the Nova 25s, getting a little bit closer to home, about 217,000. Then we get south of 200,000. Nova 26s, 197,000 open. Then we drop off quite a bit. The Jan 22s with about 160,000 contracts open. All the way down to the number 7 spot on the list, the no 15 puts. Finally see some put love here, about 145,000 contracts open there. No 35 calls, 135,000, and then the D's 20s and D's 30s with about 126 and 124,000 respectively, rounding out the top 10. Total of about 6.25 million contracts outstanding right now, about 4.4 on the calls, about 1.8 million on the puts. So nothing excessive out there from a call to put ratio. We've seen, of course, when things get a little bit wonky in that side of the fence, people start to the hackles on the back of their neck start to stand up and say, thinking perhaps something is afoot. We're not really at those levels yet for all those people out there who are diehard VIX call to put ratio watchers here. And talking about some of the other things that have been making the rounds, making the headlines of late from a volatility perspective. Mark, we talked a lot about the interesting stuff coming out of Artemis and indeed Zero Hedge last week. This week, our friend there, Manish over there at Barclays, he's making a lot of the rounds he must be putting their press agent on blast of late there, because he seems to be making the rounds in a lot of outlets. See if they have to get him on the show here to express some of these opinions as well. But he's been talking about a lot of different products, including VIX a lot of late, and kind of making some of the points we've been making as well. But he's, as what we were saying earlier, it seemed like the market had kind of priced out a lot of the China premium, a lot indeed of the Fed premium. That's what we saw certainly earlier this week, as they were squeezing the futures across the board, squeezing the implied vol out of the marketplace. Now it seems like they're putting some of that back. That's kind of what Manish was alluding to here. I believe this came out of Barron's. He was talking to those guys, and he was saying that the complacency they've kind of had built into the market going into today was really a bit overdone. He thought that, talking to a metric we like to bandy about a lot in this program, the risk premium, indeed the implied vol versus the realized vol in the market, it had gotten, for his taste, too low. He was a little bit disconcerted by that, and so he thought it was a time to actually come in and start picking up some of that realized vol out there if and when it's possible. And he was also saying that the market's discounting of China, discounting of the Fed premium was a little bit too soon on that front, for his taste anyway, because he thought there was a lot more to come from that. And so he was counseling a lot of their clients and everyone else to start perhaps positioning for some VIX to return to the upside, and certainly a lot of the paper flow out there this week seems to agree with that. A lot of people positioning on VIX upside. Also looks like the data coming out of the CFTC is backing that up on the institutional side as well. About 15,600 net long positions that the CFTC tracks tied to the VIX. That is the 8th straight week that they've seen bullish sentiment in the volatility products. That's prior to that. It was short every week of this year since February. So it seems like a lot of the sentiment, and certainly backed up by what we're seeing playing out in the market today, Mark, is that we're not going to be hanging out here for very long. What's your take on this article and indeed the general sentiment that perhaps we're heading north again for sometime soon?
It's an easy argument to make after we just had a huge sell-off. That, hey, we might tank again. And so, yeah, I mean, I understand it. I understand why you'd think it, that people are trading it that way. So it does make sense to me that maybe we do sell off again. I think that though we are probably going to make a run at 2100 before all is said and done, and we're in the middle of what appears to be a little short squeezy time right now, and I don't know that I would want to be short the market. I think we could run all the way through to all-time highs before we turn around.
Yeah, that call of his seemed a little bit more outlandish before today's session. Obviously, when when everything started to firm up, it seemed like collectively everyone kind of smacked their head and said, "Wait a minute, we've overdone this a little bit here." Speaking of overdoing it, or perhaps not overdoing it here, let's turn our attention to the other side of the index vol fence. Indeed, the individual components. Talking about, of course, we are in the teeth of earnings season. We saw a lot of big names reporting this week, including some favorites like Amazon and the myriad permutations of Google these days reporting yesterday as well. Both of those were looking fairly rich going into their announcements with, Google pricing in about a 6% move over there, and Amazon pricing in about a 9% move going into their earnings, and both of them pretty much just knocking it out of the park, blowing through the doors to the upside. Amazon, I was expecting about a 51 handle move. Google, I believe, was about a 30 handle move, 38 actually, and they both knocked it out of the park. Looking particularly at the Google/Alphabet perspective, that was pretty rich levels. Certainly going back, had to go back about a year to October of last year before you've seen that level of implied volatility going into an earnings announcement. And again, the market was in a different place last year than it is right now. So a lot of people thinking that perhaps the vol was a bit overdone going into the announcement here last night, and certainly seemed like that was not the case. Both of them rocking and rolling. In fact, as we're recording this right now, Goog up about nearly 60 handles in the marketplace, and Amazon up about nearly 40 right now. So seems like despite the fact that they were looking a little rich, they were indeed not rich enough. You guys been watching a lot of these individual names over there in the pit chat this week, Mark?
I keep running into people that are like, oh, I sell strangles around earnings, or I sell this around earnings. I don't know who is teaching these people to go out and sell premium into earnings. But here's what I know, all right, is that every time I run into somebody like this, they get burned. Statistically, there's the payoff isn't there. I mean, look at Google. Google's pricing $37. It's up 55. And it's just kind of ridiculous the way people do this. Like, there's smarter ways to trade earnings than to try and sell strangles, because you will win more often than not, but when you lose, you're going to lose bad. And that's kind of what we're seeing with Amazon and with Google or Alphabet, whatever you want to call it. I don't care. And it's pretty nuts. Although now Amazon has really backed off.
Yeah, it's only up nearly 40 handles now. But yeah, at one point today, it was trading another like 20 handles north there. So yeah, quite the rally. And you're right. I mean, people who they seem like they routinely get into this rhythm of writing a bunch of premium going into earnings, they don't have to look very far back into the rearview mirror to see the times when that didn't pay off and didn't pay off spectacularly. In Google's case, you don't have to look that far at all. This thing seems to blow out earnings to the upside or the downside at least once a year or so. So you don't need to look back 30 quarters to find an example of it blowing out the premium sellers. It's much more recent history than that, and yet still we see people trying to kind of force that approach, take that square peg into the round hole. We talk a lot of different approaches to earnings here on this program. I know your compatriot there, Andrew, your better half there, loves that kind of long premium for the couple of weeks leading into the announcement and then dumping it before all the turmoil happens. And that certainly is a safer approach to go than kind of riding over the cliff that is earnings and hoping you come out safely the other side. But there's a lot of ways to go. It's still interesting to watch out. We don't get into a lot of individual name volatility here, but it is that time of year, and so certainly worthy of a few discussion points here. I know a lot of you out there trading these names these days, and hopefully on the right side of both of these big moves this week. Looking at some other names that are catching a lot of attention right now, Mark, the shiny stuff jumping across to the commodities also on top of a lot of people's minds these days. Talking gold, of course, listeners, and it's been an interesting product to watch of late. I mentioned a few months back how we had our guest on our longer, shorter futures options show who put out a very, very well-timed research report about, looks like gold implied vol is at some historic lows. Perhaps it's a time to buy some of that. And that was pretty much the week everything took off, and it really hasn't looked back since. We're hovering from a gold vol perspective right now, about a 15.5 or so. It hit some highs, as you might imagine, in all that rock'em sock'em period back in August of nearly 26 on the big sell-off day on the 24th, and about 24 or so a couple days later on the 26th. It since has been trending downward, but still all well north of the levels we've seen coming out of the mid-July period. And a lot of people are starting to say, wait a minute, this implied vol is a wee bit, shall we say, underpriced. We've mentioned on recent shows as well, didn't seem like there was much of a heavy bias to the volatility skew out there in gold land. Seemed like it was mostly on that smile, had crept back into the surface. Not so much this week. It seems like the bias, no doubt as a result of some of the recent movements out there in gold itself, is getting pretty heavy to the upside. In fact, our old friend, like I said, he's getting quoted in a lot of products, Mark, and Manish over there at Barclays is coming out on gold as well, counseling that the skew is getting perhaps a little heavy to the upside. And he was actually recommending some 1-by-3 ratio spreads. You don't see those coming out very often. People saying, hey, go out and buy one, sell three, and take advantage of that. But there is some data backing him up, looking at particularly out in GLD, which I know is a product you like, and a lot of our listeners like to get their gold exposure through, and that the 30-day skew at least hovering about the 23rd percentile from a one-year perspective. So certainly is quite low, indicating, again, a heavy premium to the calls versus where they traditionally are in relationship to the puts. You guys are familiar a lot, I'm sure, with the investment skew. We always talk about products like the Skew Index, for example, in S&P, where the premium is always to the puts. Commodities, not so much. It's kind of where the flow is coming from a paper perspective that tends to dictate where the skew lines up. So, Mark, what's been catching your eye out there in gold vol land, and also what's your take on the skew being so rich you got to just sell three?
I mean, I don't know that I would be the skew is rich. The vol's been kind of cheap. I do like, on my Track the Trade show, I talked about doing a short butterfly where, you sell the wings and buy the thorax. And that's been a great trade. I think bond vol's been too cheap as well. And, all that stuff has been really, really good. So yeah, I've been a little surprised. I don't know that I would go out and sell three, but I definitely like the idea of shorting skew and being long meat, long the thorax.
Yeah, I was going to say, you're the only person I know who calls it the thorax. Of course, there may be thorax versus guts. Neither one is really a particularly memorable.
Thorax is, it's the wings. It's a butterfly. What's the center of a butterfly?
I get why you're using it. It's just funny. You don't really hear it bandied about much anymore. I'm now going to be short the thorax, ladies and gentlemen.
I'm long the thorax.
I'm more of an old school guts guy, I guess, myself. But hey, to each their own. Carmen Miranda, thorax.
Guts is its own trade, though. Remember?
Yes, that's true. There is that component as well. So it can be confusing. I could see why you want to delineate them, but still interesting. The thorax. We might have a whole show just on the thorax of the butterfly. But yeah, indeed, interesting stuff shaping up out here in gold land. We'll see how long that bid to the upside of the skew persists. It seems like gold is kind of very whimsical these days. The skew is rocking and rolling, and things are lining up one week, and then it's the complete polar opposite the next week. So we'll see how this plays out over the coming week. But still, at least for this week, yeah, it seems like a market bias, and kind of whichever approach you go. Maybe, I'm not sure if 1-by-3 is the ratio you want to adopt, but something that allows you to take advantage of that cheap gut/thorax, the at-the-money meat there, and then selling some of those overpriced wings, particularly to the upside in this case, then that may be a strategy that works out. 1-by-3, I don't know, but something along those lines could certainly be intriguing, turning our attention to the other side of the commodity spectrum that always gets a lot of love and attention these days is, of course, the black stuff, the Texas tea, indeed the crude vol out there, whether you're looking at OIV or looking at OVX. both hovering around a 40 level. So again, on the lower end of the range, we've seen it on over recent weeks, kind of keeping it on that's kind of slow but inevitable kind of downside from a vol perspective. We've seen little blips here and there, obviously, but the narrative, the trend over the past few months at least has certainly been the steady erosion of volatility out here in these products, and looking how the skew is lining up here versus what we've seen out there in the shiny stuff. And there is indeed a market bias here as well, but it's to the other direction. And we've kind of seen this for a few weeks now out here in crude land, where the concern, the interest, the speculation, call it what you will, is leaning still to the downside with most of the puts. You know, you get in these near-term months, the front month and what have you, sure, you got bids everywhere. But once you get in a little bit more of the rational months, as I like to call them, it definitely seems like the bias is leaning to the downside there. Which again is interesting to a lot of people, because we've been in this kind of 40 to 50 range for some time, and yet still the concern, the hedging, call it what you will, down in south and around that 40 handle or so. Mr. Sebastian, I know you like USO, but also out there in the big WTI products. Pick your poison. What's your take on what you've seen lining up out there from a vol perspective in the crude products this week?
Yeah, I mean, they continue to hold OVX and OIV up higher. There continues to be some decent volatility there, and quite the bid. It's just kind of interesting that that's the way it's been flushing out. I don't think USO's even really, and oil's really moving that much, but they're holding the vol up. They really are.
Have you guys been spouting out any trades out there in USO lately? Anything catching your eye out there?
You know what? The skew still bid. I like doing like 1x2s. That's been kind of my trade in that.
I don't know if you're following it here, but it's 1x3 or nothing this week on the Vol View show, Mark.
Well, I'm a 1x2er.
Okay,
they're gonna have to deal.
You're too low on the spectrum for us here, sir. You can keep your thorax. As we move on, listeners, you can write in. Do you like thorax, guts? What's your preferred nomenclature there for butterflies? In fact, you can let us know right now, because we're diving on into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Voicemail. Like the man said, this is the portion of the show where you guys get to join us here with your questions, your comments, your insights, your snide remarks, all of that fun stuff here on the Volatility Voicemail. Seems like a lot of you guys coming out of the woodwork after last week's program and liking that deep dive we took into the deep, dark history of volatility skew. Here's a few here. This comes from Frank W. He asks, hey, great discussion on the origins of volatility skew. I really learned a lot. I wish more programs would discuss these topics. Well, thank you, Frank. We like to get into the weeds here whenever possible, and certainly that's a point we've touched on a few times on this show in the past, but I don't think we never really dove into it with that depth, and certainly not with someone who was there at the time, which is helpful. So we get that perspective as well. Mark and I were talking like, who can we get on that we can talk to that was actually there, and kind of just a head slapping moment. Of course, Don, and so that was pretty much the inspiration for that episode. Another comment. This comes from Phil O. He writes, hey, what is it about volatility that tends to bring out the crazies? That stuff about VIX mean reversion and moral hazard was pretty deep into tinfoil hat territory. Surprised to hear that coming out of Artemis. He's referring, of course, to what we were talking about last week on the show as well, listeners, about some of the articles coming out of Zero Hedge and some other places that they were citing, essentially saying that the Fed is forcing mean reversion in the volatility markets, and there was this moral hazard they were inciting upon the marketplace by doing so, and it got into some pretty interesting areas of the marketplace. We were kind of interested and a little bit surprised by it. I think a lot of you, sounds like you guys were as well. Mark, have you evolved your opinion on that at all this week, or you still pretty much have the same stance you did last week in regards to some of the more extreme claims coming out of Zero Hedge and others?
Well, what do you take a guess?
You're not known for your evolution, but I'm just checking in.
No,
Just nonetheless.
nothing there is going to involve me. That was just again very tinfoil hatty. I don't want to get too deep into it again. I'm sure Chris has some very. I mean, he's a brilliant guy. That's what was so shocking about kind of the way the Fed is affecting things.
Yeah, the dangers of mean reversion are interesting. We're going to bring Chris on, get his side of that as well, because I'm sure he has some interesting comments on that side of the fence. But yeah, interesting stuff coming out. A lot of interesting headline making things coming out of the volatility space over the past couple of weeks. More people piling in on the skew one as well. Mark, this comes from a frequent writer in here, Mark B. He writes, "Hey, what a relief! Fantastic story of the Vol Skew Big Bang by Herr Dr. Schlesinger." He also mentions the perfect collar is a work of art. That, of course, refers to what you're saying before, Mark, about how pre-skew was it possible indeed to get that perfect collar where essentially you can get everything for free and have essentially all this fun collared portfolio for essentially, no outlay. And that would be interesting times. He also added this interesting addendum here. I'm not sure what he's referring to here. He writes, "Cool thing about selling VIX option spreads is no theta, a pure vol play at all tenors." I'm not sure what he's getting at there. If you come in and buy, like, let's say today you buy a Nove 30 call and you hold it for a week and VIX, nothing happens over the course of that week, that call is going to be worth a lot less than it was today. So I'm not sure what he's getting at here, Mark. You sure you think you have insight into his mind here as to what he means by no theta in VIX options?
No, I don't. There's no theta in VIX options. That doesn't make any sense.
That'd be nice for VIX premium buyers if that was the case.
Yeah, it would. There's a huge theta in VIX options. The theta comes out twice, actually, if you think about it. It comes out through contango, and it also comes out through standard option theta. So pretty crazy.
Bit of a double whammy from a theta perspective. But you're welcome to try us out yourself, listeners. Go out and buy that proverbial Nove 30 or whichever strike to the upside floats your boat and put it away for a little while and see what happens. And you could see for yourself if there is indeed theta or not. I recommend doing that if you want to experiment in a paper trading account, of course. You don't want to spend your own money learning these things the hard way. Moving on to another question, getting away from the skew stuff for a second. This comes from Iron C. So I'm not sure. Maybe he's an Iron Condor fan. Probably. We'll see. He writes, "Hey, so Talib and the 1x2 guy, I'm thinking he's referring to the VIX 1x2 guy, both love back spreads. Are back spreads pretty much the ideal volatility trading position? They have little or no net outlay and let you stay in the game long enough to profit from the big moves. I have to say I'm becoming a fan. Are there any secret downsides that I'm missing?" What he's referring to, listeners, of course, with the 1x2 is the big spread we've seen going up in the VIX options of late, where the customer is essentially selling one near close to the money call, buying two of a farther out of the money call, and using that essentially to finance his swing at the bat. So when the big pops happen, like they did in August, he's got those two to the upside to really pay off for him. In the meantime, he's financing it, so he's not shelling out a lot, not just buying two out of the money calls, for example. And we also had a good debate on this program, I think a few years back now, discussing what you would expect someone like Nassim Taleb and his myriad black swan tomes, what you would expect him to be trading, which would be essentially long all those out of the money puts that he's always talking about here in his product versus what they actually trade, which is indeed this same approach, this kind of short a lot of out of the money, at the money premium, and then long out of the money wings, again, using that at the money premium to finance that swing at the bat for when the big quote unquote black swan event does come to pass. He's got that extra premium to the downside to finance it. And yeah, Mark, I think we've said this before on the show. We're kind of fans of that approach in terms of all the myriad different ways we've seen people trying to position in VIX. We talked this week about bullish risk reversals. That's kind of the trade du jour this week. But this one is an interesting approach, and it's certainly, if you have the capital to keep it up, it certainly can be profitable in the long term. We saw that our friend in the 1x2, he kept it up, and it didn't work out that great, but he didn't lose a ton, didn't make a ton, and then bam, the big aberration moment happened, which is why you want to be in VIX, and he was able to capture that. So I'm guessing, Mark, that you're like me, you're a bit of a fan of this strategy as well, particularly when it comes to the VIX.
Yeah, I'm a huge fan of this strategy. I like it a lot. And so I'm definitely pleased with how he did that. It was thoughtful hedges in VIX can be extremely effective. It's just cruddy simpleton ones that end up not working.
So you're saying the guy who comes out and buys the Feb 75 calls, that is not a nuanced use of the product?
It is not a nuanced use of the product.
He's no fan of Carmen Miranda, I can assure you. All right, let's see. We got time for a couple more here. I like to squeeze in as many comments and questions from you guys as I can. Let's see. This one comes from Vars. Not sure how you pronounce that. He or she writes, hey, any good recommendations for variance swap volume data? This is an interesting one. Of course, we're always talking a lot here on this program, listeners, about the listed products, listed VIX options, et cetera. It's because there's a lot more transparency to those, the variance swap stuff. Aside from a few experiments they've done on the CBOE and others trying to list some variance type products there, the vast majority of that, the lion's share, goes up OTC. And the problem you have with that is that you have a handful of players putting up the lion's share of that. They tend to guard that information pretty tightly. They want to put it out to clients, and that's about it. And even then, they kind of put it out on a need-to-know basis. And so if you're not out there getting those shows and putting it up there, they don't have an interest in showing it to you. And also, sometimes the information you may hear about that may be, shall we say, a little bit inflated or misleading. So you have to be really careful when you're talking about parsing that kind of data, having an accurate, reliable source that could span not just one house, but a bunch of them, and see what they're doing at once. And so that's one of the challenges we have this program, quite frankly, is trying to find a good, reliable, accurate source for all of that kind of volume going up. And we've had struggles with that ourselves here. We get insight into a couple trades going up here or there, and those big prints here or there. Certainly those are interesting and informative, but kind of the whole scope of the marketplace, which is what we like to really see, so we can kind of dig into it for you guys. It's more of a bit challenging. Mark, I hate to leave this guy hanging, but do you have any other good sources, aside from the ones I just mentioned, that you can really recommend for someone if they want to go try to get their hands on some of this data?
Yeah, I mean, TD has that kind of back trader you can go through. There are like other back traders that you can pull stuff out of. Otherwise you just have to go buy it or subscribe to it. There's who's got data. iVolatility does live vol, bar chart. That's about it. That actually goes out and just sells data, right? Anybody else I'm thinking of that I'm forgetting? Bloomberg. That's it.
Yeah, and even then, a lot of that's not going to have some of the good variant stuff in there, just because that stuff is fragmented, I think, to say the least. So
your best bet is to open up a brokerage account with a large broker like RBC or our friends at BCG, and just have them tell you when all this stuff goes up and where the trades are. Of course, you need to have $100 million to do that. Yeah. So he may be SOL there.
Yeah, if you're the size money guy on the account, you're not gonna have any problem getting access to data and getting, like I said, getting those shows because they want you to trade it. But outside of that, there aren't many avenues for you guys, unfortunately, the lion's share of our listeners, to get access to that. And we're still working on ways we can get some reliable ones on a regular basis that we can kind of discuss. Because obviously all the big prints we're seeing going up in the listed space, the lion's share of those have some sort of OTC component to them as well, whether they're hedging one against the other or extending in the OTC, whatever the case may be. And we'd love to be able to kind of sink our teeth into those as well for you guys. Right now we're only seeing part of the picture. But unfortunately, that one part of the picture is very clear, and one part of the picture is opaque, to say the least. And so, again, that's why we've seen so many of the regulators trying to push a lot of that volume onto the listed lit venues for that exact reason. They want to see what's actually going up out there, who's trading what, who's printing what prices things are going up at, so people aren't getting taken advantage of in that sense. And a lot of other fun things. Let's see if we can round it out here. We got one more quick one here, Mark. This kind of refers to what we were talking about before. We touched on it mostly in the beginning of the episode. Maybe you want to add a couple of things. This comes from Dan D. He writes, hey, can you please explain the CBOE Skew Index? What is it? What does it measure? Thank you. We touched on this top of the show. Puts over calls from an implied volatility perspective. It's kind of been rocking and rolling a lot of late. Kind of measures that sentiment, how much implied volatility there is to the puts versus the calls in the SPX index out there. Mark, anything else you want to add for our friend here who's cutting his teeth on skew?
Susquehanna puts out some really good skew research. There's a few other shops that do. There's all sorts of different ways of looking at skew. CBOE puts out their skew index is really more kind of black swan type skew stuff, most people, the skew that they look at is more around the 10 delta level of the put, the 25 delta level of put, and the 25 and 10 delta level of call, and how they're related to each other. There are a lot fewer that are like, I'm interested in what the 1 delta put in SPX is doing. So and that part of the skew curve I find far more valuable than the skew index itself.
Yeah, we've talked about it before, kind of some of the issues that go into the construction of that index. We've said them before on the show, where we like that there's someone out there disseminating that data, but yeah, the way they distribute it, the way they quote it, as you mentioned, the series they tend to include in it, there is room for some other skew quoting type products out there. And so, listeners, if you're just cutting your teeth on this stuff, I encourage you to look at a few others, kind of get a more holistic view of it. The skew index can be a little bit obtuse when you first try to cut your teeth on it. All right, good questions. You got time for one more segment. It means it's time, listeners, to dive right on into the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, listeners, as we wrap up the show, the rally has continued here in the broad marketplace. S&P up about 1% now, is up about 0.75% to start the show. Dow following suit, and that little bit of bid we saw peeking into the futures and indeed the VIX Cash starting to come out now. VIX Cash selling off a little bit here as we're wrapping up the show here. So that question leads, Mark, to whither shall we be next week from a VIX Cash perspective? It's kind of been all downside all the time for the past few weeks. Today's early upside spurt notwithstanding. Of course, all the paper we talked about throughout the show and all the research and people we talked about seem to be leading on upside. I don't know if I'm that convinced on, this stuff, all these 1x2s and things we're seeing are not 1x2s, but bullish risk reversals and things out there in VIX predicting a really big pop. I'm not sure if I'm on that train, but I could probably see this in the 15 to 16 handle this time next week. Where are you falling, Mark? Think we'll be right about here? You think we're going to be in that home run territory, or a little bit higher, a little bit lower? Where do you fall on the crystal ball?
I think we'll probably be a little bit higher, especially because we've got the Federal Reserve meeting next week. People are going to think about, we still have, so, I think what we're really going to see is vol kind of rally into the Federal Reserve meeting and then maybe back off unless they go and do something stupid like raise rates.
I don't know about you, but I was really enjoying that 2 to 3 week period where we didn't have to talk about the Fed. It was It was blissful. We were just talking about things that were actually concrete, like earnings. Will they, won't they? Oh, they did. Oh, they didn't. Things that were actually concrete and material to the marketplace, and not this ridiculous dance coming out of the Fed. Unfortunately, you're right. That will butt its head back into the picture, and there's always a little bit of a premium associated with that. Hopefully that's a quick one-off and done, and we're not going to be talking about that again until sometime in the distant future. But as we've seen, the Fed doesn't want it that way. The Fed wants to be in the conversation all the time, every day, and we've said our piece on whether that's a healthy viewpoint or not. But still, you're right, that Fed premium always has a way of sneaking into the market. So there you go, listeners. 2 votes for slightly higher, somewhere in the 15 to 16 range here this time next week. We'll see if all that comes to pass, or if the Fed really just screws the pooch and sends us spiraling off into the stratosphere. We'll see next time. But unfortunately, that's all the time we have for the Crystal Ball episodes. Also all the time we have for this episode of Vol Views. But before we go, as always, Mr. Carmen Miranda Fan Club, what is coming down the pike, either in the fund or in the land of Option Pit, that may interest our listeners?
All right, well, the fund is expecting to probably we're going to close our first round of funding at the end of the month. We're excited about that. And then the next round will be December 31st. We only take accredited investors. So if you're accredited and you're interested in hearing about what we do, feel free to reach out to me or reach out to Mark so he can hook you up with me. And at Option Pit, we are doing a webinar on volatility and earnings on November 7th. It's another Saturday class, 4-hour class. Go to optionpit.com/vol primer. We're going to go through earnings, non-directional plays, using volatility for directional plays, and we're going to talk a little about volatility in and of itself and the Greeks. Should be a great time.
It's going to take you 4 hours to tell people to sell straddles going into earnings?
Yeah, exactly.
You can do that in 20 minutes.
Can't lose. Can't lose selling straddles.
Check that out over there at optionpit.com, listeners, to learn more. And on behalf of the Greasy Meatball and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing, and of course for sending in such great and varied questions. Keep them coming. We love to hear from you guys. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.